Most people think wealth is built by reacting well after a crash begins. That is almost never where the biggest money is made. The biggest money is made before the crash gets a name, before the anchors start sounding frightened, before the economists start rewriting their old confidence into new caution, before the public understands that what looked like a normal market was really an auction waiting for forced sellers. That is the part I want you to understand, because a crash is not a storm in the way most people imagine it. It is not random weather. It is not some wild accident that visits the honest and the foolish in equal proportion. A serious crash is an auction of bad timing, an auction of weak balance sheets, an auction of assets sold by people who no longer have the luxury of waiting. And the people who get rich in that auction are almost never the people who kept asking whether the rain might stop. They are the people who arrived with cash, legal priority, durable claims on necessity, and the patience to buy while everyone else was being priced for urgency. That is the mother line for everything I am about to tell you. The investors who build generational wealth in crashes do not win because they predict the exact day of the collapse. They win because they prepare the right forms of purchasing power and ownership before forced sellers enter the room, then use the crash as a transfer mechanism rather than experiencing it as a tragedy. That is the line. Read it again, because once you understand it, you stop asking the childish question. You stop asking what will go up during the crash. You start asking the adult question, what stays liquid? What rises in relative power when everyone else loses optionality? And what legal or physical claim lets me buy real assets from people who no longer have time? That is the only serious question. Most people never ask it. They were not trained to. They were trained to diversify, wait, hope, and pray that time itself would forgive every entry price, every debt load, every valuation, every cycle. That advice is not useless. It is only incomplete. It is advice designed for people who will never think in terms of transfer. The people who do think in terms of transfer use a different script. They do not start 24 hours after the crash. They start 18 to 24 months before it. They get quieter, they get more liquid, they move out of glamour and into leverage over the next phase. They buy things that sound boring enough to be ignored by the public and powerful enough to reshape a family line when the public finally learns why they were chosen. That is why I take this topic seriously. Not because I enjoy fear, because I know how expensive it is to arrive at an auction empty-handed. Now let me tell you what I believe the source material was really giving you. It looked like 5 assets. That is too shallow. What it was really giving you was 5 mechanisms, 5 different ways to convert a future crash into either defense, offense, or direct transfer of ownership. That is how I want you to hear it, not as a listicle, as a system. The first mechanism is what I call ammunition. The second is what I call priority. The third is what I call necessity. The fourth is what I call scarcity. The fifth is what I call monopoly transfer. Those 5 together explain more about how real money behaves before a collapse than 1,000 pages of polite financial journalism. Now let me start with ammunition. A lot of people hear cash and immediately think cowardice. That is why they stay broke. Cash is not cowardice when the cycle is late. Cash is stored choice. Cash is delayed aggression. Cash is the right to buy what other people will be forced to sell when their own structure breaks before the asset does. That is why the richest operators in the world hold so much of it before the damage becomes obvious to the public. The public sees idle money. I see loaded time. I see a weapon with no recoil until the exact moment it is needed. This is what the source was really saying when it pointed to Buffett sitting on an enormous pile of Treasury bills and cash equivalents. The media always calls that old-fashioned when the market is still rising. Fine. The media is not in the business of being early. It is in the business of sounding current. That is different. A Treasury bill is not exciting. That is precisely why it matters. It does not ask the economy for optimism. It does not ask the equity market for faith. It does not ask a venture multiple, a commodity cycle, or a policy pivot to justify itself. It survives. And survival becomes the most aggressive quality in the room once everything else is on sale. I want to say that differently because people keep missing it. The wealthy do not hold short-duration sovereign paper because they lack imagination. They hold it because they understand sequence. If I have 10 million in liquid government paper while the SP is cut in half, while wonderful businesses are being sold by panicked pension funds, while real estate owners are gasping for refinancing, while private markets are suddenly humble enough to take lower terms, then my boring position becomes the most dangerous asset in the whole cycle, because it can become everything else. That is ammunition. It is not return. It is conversion power. The crowd worships return during the boom. Serious money worships conversion power before the bust. That is the difference. Now let me make this harder. Most people are not ruined by the crash itself. They are ruined by the fact that they entered the crash fully invested, illiquid, indebted, and emotionally dependent on prices staying generous. That is why they experience a collapse as injury. The prepared experience it as inventory. The unprepared ask, how much have I lost? The prepared ask, what can I finally buy? That is the first identity flip. Stop thinking like a holder of assets. Start thinking like a future buyer of distress. That mental move alone changes everything. Now let me take you to the second mechanism, priority. This is the part the public almost never understands because the public was trained to look at stocks, not at the legal ladder above them. A company in trouble creates two completely different worlds. One world belongs to the shareholder, the other belongs to the creditor. The shareholder is holding a hope claim. The creditor, especially the right kind of creditor, can end up holding a control claim. That is not a small difference. It is the whole game. Distressed debt looks ugly. Because it should look ugly, it only becomes available at the price that makes fortunes when most people already believe the situation is beyond saving. That is when sophisticated money shows up. Not to buy hope, to buy a legal position. And legal position is what matters in bankruptcy. The public thinks a bankrupt company means death. That is not necessarily true. Often it means ownership is being reassigned. The old equity is wiped, the debt stack gets restructured. The people who bought obligations at 15 or 20 cents on the dollar can emerge holding equity in the reorganized enterprise. That is not trading, that is transfer. Howard Marks understood this coldly. Brookfield understood it coldly. Every serious distressed investor in the last century understood it coldly. You do not have to predict whether the company survives as currently constituted. You have to understand where in the legal waterfall value will still be recoverable and at what price the market is offering you that position. That is priority, and it is one of the harshest truths in all of capitalism. The same collapse that wipes out public shareholders can create extraordinary new ownership for the people willing and able to buy stronger claims when the price of those claims is set by panic rather than by eventual asset value. That is why I say the system is not neutral. It is not evil in some cartoon way. It is simply optimized for those who understand structure better than story. The story says, this company is dying. The structural investor asks, what are the assets worth, who stands above whom, and what happens to control once the court replaces emotion with priority? That is the right question. The public almost never asks it. That is why the public almost never receives the answer in the form of wealth. Now let me say something that will make some people uncomfortable. Every major downturn is a legal transfer mechanism as much as it is an economic one. Jobs are lost. Families are strained. Savings disappear. And on the other side of that human damage, productive assets move from dispersed, fragile hands into concentrated, patient hands with legal sophistication and cash. That is what distress does. And distressed debt is one of the cleanest ways that transfer happens without ever being described that way on television. Now let me move to the third mechanism, necessity. This is where the world gets much older than finance people like to admit. Before there were markets, there was hunger. Before there were central banks, there were calories. Before there were retirement accounts and derivatives and beautiful spreadsheets, there were people who either controlled productive land or depended on someone who did. That basic truth has not gone away just because the modern mind finds farmland too simple to be interesting. Simple things are often the ones that survive. The longest productive agricultural land has one brutal advantage over almost every other asset class. Its floor is not confidence. Its floor is biology. Human beings still need to eat while currencies fail. They still need to eat while real estate freezes. They still need to eat while the equity market is preaching humility that matters. More than the crowd wants to admit. The source material was right to stress that farmland is not dirt. It is future calories in asset form. It is a claim on necessity. That is why it behaves so differently in monetary and financial disorder. Bill Gates did not accumulate farmland because it looks pretty from a helicopter. Roman elites did not accumulate land during debt crises because they were sentimental. Post-war opportunists did not buy agricultural property because they wanted to reconnect with nature. They wanted the one thing that survives when paper breaks, productive necessity. This matters because most assets depend on valuation culture. Farmland depends on food culture. And food culture is another name for civilization continuing. That is a much deeper support. Now, let me sharpen the point. Not all land matters equally. Land serving export channels. Land with good water, good soil. And connection to real demand is not the same thing as romantic acreage with no productive edge. I do not worship land in the abstract. I respect productive land tied to unavoidable demand. That is the key. A crash is not a test of what looked good in a boom. It is a test of what remains economically meaningful when financing and confidence have both deteriorated. Food wins that test again and again. That is why I call this necessity. Not because it makes you feel noble, because it makes the asset harder to fully destroy without destroying daily life itself. Now let me move to the fourth mechanism, scarcity. This is where polite people roll their eyes because they confuse culture with luxury and luxury with frivolity. Fine, ignore them. Blue chip art, and I mean truly blue chip art, not decorative nonsense dressed up as passion, operates under one of the most powerful rules in finance. Supply is fixed in the most literal possible way. The artist is dead. No central bank can create another masterpiece to relieve the pressure. No policy committee can expand the supply. No earnings miss can dilute the claim. That matters. The source material was right to frame serious art, not as beauty first, but as non-correlated scarcity wrapped in cultural legitimacy. That is exactly why the wealthy move there before disorder becomes obvious. They are not buying wall decor. They are moving some share of wealth into an asset that sits outside ordinary financial correlations and cannot be printed against. Now, I want to be precise. I am not telling an ordinary person to start shopping for Picassos. That would be ridiculous. I am telling you to understand the principle. When the supply of money can expand violently, assets with truly fixed supply and deep durable demand become more valuable as vaults, not growth engines vaults. The wealthy understand this instinctively. That is why private art deals accelerate before visible stress, because the people making them are not seeking thrill. They are seeking shelter that still stores prestige, privacy, and scarcity in one package. And there is a second layer here that matters. Private treaty sales are not just about the asset, they are about the terms. Opacity matters. A quiet transaction between sophisticated parties can happen at a price and on a timetable the public never sees. That invisibility is part of the advantage, because the best opportunities in stress markets are not only in public securities, they are in private repricings. Nobody with a brokerage app will ever be invited to see. That is scarcity. Not just a thing, a category of thing the modern monetary machine cannot cheaply replicate. That is what gives it its strange resilience. Now let me move to the fifth mechanism, monopoly transfer. This is where the gloves come off. The first four mechanisms are mostly defensive or hybrid. They protect, preserve, or create advantageous entry. The fifth is different. The fifth is offensive. It is where new fortunes are built during and after crashes, not merely defended. And it lives in the ugliest, least glamorous, most ignored corner of economic life: essential service monopolies, waste collection, self-storage, funeral services, pest control, water treatment, medical waste, the businesses nobody brags about at a cocktail party. Exactly, that is why they matter. Because glamour gets overbid in the expansion, necessity gets underpriced until the contraction. Then the contraction reveals a beautiful and ruthless truth. People do not stop producing garbage because GDP fell. They do not stop dying because rates rose. They do not stop needing storage when they downsize out of homes they cannot carry. They do not stop needing pest control because unemployment is rude. These cash flows keep moving when narrative sectors are being dismembered. That is what makes them so powerful. And once leveraged smaller operators begin failing in a downturn, serious capital buys their routes, contracts, customer lists, and regional position at prices that look almost criminal relative to the durability of the demand. That is monopoly transfer. Not because the acquiring party invented something, because the acquiring party understood that the best cash flows in a crash are often the cash flows nobody romanticized enough to overprice when times were easy. Wayne Huizenga understood that in waste, every competent private equity operator with a long memory understands it across the whole field of boring necessity. This is why I always say the market does not reward moral beauty. It rewards strategic boringness when the cycle turns. The middle class spent the boom financing image. The quiet operators spent it waiting to buy the toll booths of daily life. That is the transfer. And once you see it, you can never unsee it. Now, let me step back and show you the deeper pattern. Ammunition gives you the right to buy. Priority gives you the right part of the capital stack. Necessity gives you claims tied to survival. Scarcity gives you protection against monetary dilution. Monopoly transfer gives you recurring cash flow in sectors whose demand barely asks the economy for permission. That is not a list. That is a war plan. That is how serious wealth behaves when it believes the next several years may include disorder. This is also why ordinary advice becomes so dangerous late in the cycle. Stay invested is not wrong. It is just not the whole map. Diversify is not wrong either. It is just usually said by people who mean diversify among visible paper claims instead of across legal seniority, productive necessity. real optionality and jurisdiction of demand. That is too weak. Much too weak. Real crash preparation is not about owning many things. It is about owning the right forms of power when forced selling begins. That is the second identity flip. Stop thinking like a saver. Start thinking like a buyer of distress and a collector of structural advantages. A saver hopes time will be kind. A prepared buyer expects time to get violent and wants to know how to profit from the violence without becoming its victim. Those are different minds. The world pays them very differently. Now let me say something even harder. A lot of people will hear a framework like this and immediately translate it into, I need to be a billionaire to matter. That is defeatist and false. You may not buy private treaty art. You may not sit at the top of a bankruptcy waterfall with a law firm and a distressed desk doing the paperwork. Fine. You can still learn the principles. You can still understand why cash matters more before a crash than hot narratives do. You can still understand that essential businesses with durable cash flow deserve more respect than flashy stories. You can still understand that productive necessity beats fashionable abstraction when the cycle gets cruel. You can still understand that the right legal claim can be worth more than the right opinion. That is already enough to make you more dangerous than the average investor, because the average investor is not losing to genius. He is losing to structure. Now let me say something still harder. The financial system never needed to openly hide this from you. It obscured it by making the mainstream version of prudence sound complete. That was enough. People were told to diversify and hold. They were not told what the sophisticated money was buying 18 to 24 months before crises. They were not told that cash was being accumulated not from fear but from aggression delayed. They were not told that private buyers were moving into scarcity and necessity while the public was still busy debating whether risk assets had one more good year left. They were not told that every great collapse also functions as an organized transfer of productive ownership from the underprepared to the overprepared. That information was always technically available. It was simply not translated into the emotional language ordinary people use to understand their own vulnerability. That is what I am trying to do now. Not scare you, clarify the board. Now let me give you the operating system I would want you to use. First, stop thinking of crashes as random disasters. Think of them as scheduled transfer windows preceded by visible changes in behavior from serious capital. Second, treat cash and short sovereign paper as ammunition, not as dead money, when the cycle is late. Third, learn to distinguish a good company from a good legal claim. In distress, the second often matters more. Fourth, favor necessity over glamour whenever you suspect financing conditions may soon become the real story. Fifth, study sectors the crowd ignores in booms, because those are often the sectors that become the highest quality offensive acquisitions in busts. Sixth, stop worshiping diversification by labels and start thinking in terms of optionality, legal priority, scarcity, and inelastic demand. Seventh, ask yourself one merciless question. If the next crash has already begun casting its shadow forward into today, positioning, where do I want to be standing when forced sellers finally arrive? That is the operating system. Not panic preparation, not prediction positioning, not vibes. Structure. Now let me put the blade into this as cleanly as I can. Before every major economic crash, rich people do not merely buy safe assets. They buy purchasing power, legal priority, productive necessity, non-printable scarcity, and monopolies over the boring functions of daily life. That is what they are really buying. They are buying the right to stand inside the next transfer with strength, while the rest of the market arrives with stories and no cash. That is the real lesson. And if you remember nothing else from what I said, remember this: generational wealth is not usually built by reacting brilliantly in the middle of the panic. It is built by preparing quietly enough, early enough, and structurally enough that when the panic finally begins, you do not experience it as the end of a cycle. You experience it as the beginning of your shopping season.